Welcome to our F7 revision session. My name is Francis Braganza, and I intend to take you through two sessions today. And when I see you next Monday on the 22nd, we'll do two more sessions. But welcome to everyone. And if you have any problems at all, do give us a shout, put it onto the message board, and I shall answer it as soon as I see it. But please feel free to ask any questions. And the most important thing, I suppose, is I must get across to you the need to do a little bit of homework as well. We still have a few days before the exam. The course is being run a little bit early, which is good. So you have a bit of time to catch up with homework and that kind of thing. It's a very easy exam. It's just a very, very big syllabus. And as you know, with the 60 marks of multiple choice questions these days, students are getting a bit worried about it who haven't covered the entire syllabus. So even when it was 40 marks, some people who were just targeting a few questions, a few big topics, like it used to be under the old style exam paper, they're getting caught out. So the pass rate has fallen slightly in the most recent exam, but it's still very close to 50% worldwide. That includes people who do no courses. So feel encouraged. If you have some idea of the basics and you've put some time into studying the class notes, if you haven't, make sure you do it before the exam. If you do that, you should easily pass. Now, let's have a look at the program that I've asked the managers to upload for you. And I personally put it onto the message board on the website. So have a look at that. So what you need to do is to be able to upload these exam papers, as well as have to hand the revision kit, and then the course will go smoothly. But you must have a paper copy of the exam papers, past exam papers, and you can write all over them like you do in the exam. Okay, so that's the important point. So there you are. That's our Monday today, 12:15 to 3 o'clock, and then there's an hour's gap. And then later today, I will be doing the next session. And as time goes on, there's a revision mock, which I've recently written for you to attempt. If you do it and send it in, I'll mark it myself. And there's obviously a closing date so that the admin can handle all the scripts coming in. And when I see you next Monday, that's a closing date for the submission of the mock exam. Then I shall start marking, or as soon as you send it in, I'll mark and send it back. So next Monday we do all those other topics, mainly the MCQs. Though in the second session next Monday, excuse me, I intend to do some more MCQs, of course, and then ratios and interpretation, bits of cash flow, that kind of thing. So that's the plan. And then there's a mentoring session towards the end of that week, the 26th. There you are. There's a little bit there for you to have a look at. All right, so the first thing I've got to do today is this question called Pallister. Now, as you know, the ACCA are not publishing full papers. In my opinion, they should, but they don't, and that's their decision. So we're trying to get them to change their minds, but we are, a small college compared to the size of the ACCA, but we are trying to influence them. Now, with regard to last year's exams, they did a hybrid, a mixture of September and December's exams, and left out the two lots of MCQs. I presume because the MCQs are going to be recycled, used again and again. So they haven't published it because obviously lecturers and students will master excuse me, master the past exam MCQs and therefore give our students an advantage. But that's always been the case for the 100 years that ACCA have been around for. So they've always published past exams, so I'm a bit disappointed, but there we are. The ones they have published, the September and December hybrid they call it, that has a wonderful consolidated statement of financial position, and then later I do one with a profit and loss. So that's the plan for the morning for the first session, and then I'll finish that in the second session and then do some published accounts. So that's the plan. As I say, the most important thing is that you must download all of this. You have been given notice by the manager who runs this, and of course I personally put it on the message board as well so that you have another look at those questions. But you need to download those so that you can mark the questions as we go along. Okay, that's my hope. All right, the question called Pallister. If I can flick on to the question itself, here we are. So why am I doing that? If you study page 6 of the class notes, you'll see the new exam paper format. If you are resitting and you haven't been able to do a long course and are not aware of the changes are quite dramatic. As you can see there, section A has 30 marks and that has 15 questions, multiple choice questions of 2 marks each. They're random MCQs. A few will be on consolidations, a few will be on standards, could be government grants, could be research and development, could be leasing, could be anything really, revenue. So any standard can come up, random is the word. So published accounts, bit of ratios, bit of consolidations. Then you come to section B, which has 3 different scenarios. A company spending money on research and development, or by the way, it has some tax problems or tax complications. Can you sort it out, please? So you'll get 3 different scenarios, but each of those scenarios would cover more than one standard, could cover several standards. Could be impairment, could be anything really. So that's where students will be getting caught out, I'd say, if they haven't covered the entire syllabus. So 5 questions of 2 marks each, that makes it 10. 10 times 3 scenarios makes it 30. So as you can see, 60 marks of this new exam is on MCQs. And then beyond that, section C is the more traditional type of question, 20-mark questions. 2 of them you'll have to face on 2 out of those 3 topics. Published accounts, including IASs and IFRSs, called standards, accounting standards. So that's published accounts. The other one, of course, is consolidations, either CSFP, financial position, or P&L, and of course ratios and interpretation, which seems to be the most popular question of the exam, and it's come up in the last 8 exams without a break. Seems like it's a permanent feature of the paper. I can't guarantee it, but it looks pretty close to being guaranteed. So naturally, when I'm doing making my choice of revision questions to do, I'm focused on those 3 big areas. And on top of that, of course, you have to cover the entire spectrum of standards. It's easy for me. I used to teach a paper on ACCA that was 90% on the standards, 90% written, yes, and 10% numbers, but the whole paper was on the standards. So it's called regulatory framework. I taught that for about 12 years till they changed the syllabus. So I feel pretty relaxed about the accounting standards, but not all students would have put in the time, because obviously you've got other things to do as well. This is not your job like it was for me. So there you are. The other thing I'd like you to do is to pick up the examiner's comments from the June exam, and in that you'll see the examiner saying you've got to cover lots and lots of things, and the reasons why people do well or badly. Yes, so that's what basically is being covered. All right, so where are we? Let's have a look at the question. It is called Pallister, which, as you can see, is this one here, Pallister. So let's have a look. Hybrid. Do have a read of the question paper. You should have it with you, or we can download it now. You can do it within a few seconds. But ideally, if you have a printed version, a hard copy, you can write all over it like I'm doing, as you will be doing in the exam. So one technique I use myself is to look at the requirements quite soon. Prepare a consolidated statement of financial position. So, excuse me, that's my first concern. It, as you can see there, it carries 25 marks, so it's bound to be quite serious. So I'm going to keep 2 pages aside. Then there's some discussion, 5 marks, so 1 page. And then 2 and 1, 3, page 4 will be my workings. So be very organized, very systematic. They want to see a professional in action. I appreciate that's a 30-mark question. In the days we used to get 30-mark questions until this last June, the June just gone by a few months ago. We used to get 30-mark questions. And so I've picked out a question from there on the grounds that if I do a 30-mark question with you, it'll be like doing 1.5 questions if there were 20 marks each. So allow me to do a nice searching examination question so that it picks up lots and lots of points. Or put another way, it's like doing a 20-mark question plus, say, 5 2-mark MCQs coming to 10. 20 plus 10 is 30. So that's the best way to look at it. So let's immediately open up our required accounts. So let's do so. So this is your September, December 2015, what's called a hybrid exam paper called Pallister. Now, I'm not going to rush through these questions as if I was doing it in the exam, because obviously it won't make any sense to you. So I'm going to do it at about half speed so that I can stop and explain as we go along. So we're learning rather than just you watch me doing it at exam speed without saying a word. So I don't like to teach like that, because the whole idea is that you should pass, not me. Of course I'd pass, but it's you. CSFP as at September 2015, perfectly acceptable abbreviation. A couple of $signs is quite common. And then if I can do another page, Pallister CSFP continued, all $signs, etc. Page 3 is where I would like to make sure I pick up those 5 discussion marks, or however much it might be in this coming exam. Let's have a read of it. Talks about, would you give that a quick read, please? What are the requirements? Have a read of part B. So let's write that out. Requirements, how investment in someone called Mino is treated by dilemma. Okay, and it's 5 marks. Obviously, you need to do 5 points at least. We're then moving to page 4, where I intend to do some workings. I'll do the workings very slowly, explaining all the little implications of it, because obviously they could come up as MCQ. So let's consider each working almost like a separate MCQ, because MCQs are 60% of this new style exam. I've kept plenty of time aside to do just MCQs with you. Pallister workings. The first working always is the group structure. Clearly, the only way I can do this course is to use our LSPF interactive technique, which is established in that 500-page class notes, which I've written myself, and all the techniques and so on in there. So if you need to revise that, revise pages, I believe it's about 28 to 31. Okay, that's what, from the class notes, that's what you need to look up. And of course, the associate chapter. Maybe page 61 as well, which has the P&L format. Okay, so half a dozen pages from your class notes approximately. So now let's read the question together to get some meaning out of it. Where's my question? Here it is. On the 1st of January 2015, so immediately I'm thinking to myself, better put down the year, the latest current year. The current year is 1/7/14 to June 15. So it says on the 1st of January 2015. So what does that mean? A mid-year acquisition. Pallister acquired 75% of Stretcher's equity shares by means of an immediate share exchange. Underline immediate share exchange of 2 shares in Pallister for every 5 shares in Stretcher. Keep calm when you read things like that. 2 shares in the parent for every 5 shares that you acquire in Stretcher. So I'll be Stretcher, the subsidiary. You be Pallister, the parent. The fair value of Pallister and Stretcher shares on that date, the date of acquisition, was $4 and $3 respectively. You have to be really careful because they mentioned the name Pallister first and Stretcher second. Pallister obviously refers to $4 and Stretcher refers to this $3. And as you know, the $3 of course is used for your NCI. Okay, so I'm going to say that's for the NCI. As we've done throughout the course, nothing new. So you mustn't get them confused. In addition to the share exchange, Pallister will make a cash payment of $1.32 per acquired share, postponed, deferred for about a year. Yes, it is exactly a year away. So that's 1 year away after acquisition. Because it's 1 year away, you discount it. And of course, the moment you discount it, you have to do something called unwinding. They go hand in hand. So you're promising me, let's say you're the parent and the subsidiary, you're promising me some of your shares, which I gratefully accept. The shares are valued at whatever price at date of acquisition for the parent. And of course, the parent shares plus the future money promised together, plus the NCIs of course, constitutes the investment at cost. That you have to compare to the net assets to give goodwill. That's the process over these first two questions. Okay, a very high chance of the examiner setting consolidations as one of the big 20 markers this time. And I can tell you, if it doesn't come up as a 20-mark MCQ because the two questions have been used up by interpretations and published, so if it doesn't come up as a 20-marker, the MCQs are going to have lots and lots and lots of consolidations in there. Okay, so you've got to make a decision to prepare for a 20-marker for consolidations and for published and for ratios. And if one of them doesn't come up, the MCQs will be full of that particular topic. So that's how I think it's going to go. But let's, for the next little while, assume that one of the 20 markers is consolidation plus some of the MCQs, because that's very popular with our particular examiner. All right, deferred means postponed. Pallister has not recorded any of the consideration, so it's not there. So it's not recorded any of the consideration for stretcher in his financial statements. Is that a way of saying, hey, you must do it? Okay, and as you can see, if you acquired 75%, so if this is the parent, and this is a 75% sub, and these are $1 shares, if you multiply this by 75, the number of shares you've acquired is obviously 15,000. Acquired. So I'll write there shares acquired. My friends who are markers tell me that the weaker student gives the parent shares to all the shareholders of the subsidiary. But think about it, if you've acquired 15,000 shares, it's only to those shareholders you offer your consideration to take over the shares. It's like, you know, purchase consideration, like a contract. You take away my shares, you give me your cash or whatever, or your shares, and I'm happy. But what you can't do is to give the parent shares to the other 5,000 who you didn't take over. Okay, these are common mistakes. And as I say, be very careful about not swapping the $4 and the $3. Okay, so you must understand that a price has been decided. We don't know what that price is at this stage. Okay, and whenever you see the $3, that's used for the NCI. And so the parent shares are worth $4. If you switch them around, you are finished in terms of goodwill, and you might easily fail the whole question. And if you fail a 20 marker, that's a lot of marks thrown away. Okay, but it's very easy to get 12, 13 marks out of these questions, just like that. Easy to get 60, 65%. Beyond that, you have to work quite hard to get there. Now, you get the feeling that that first paragraph is usually pretty demanding, and that's just the examiner's style. He just puts you under pressure immediately. So you can see there are 15,000 shares acquired, and each of these shares are worth 132 per acquired share. Okay, so let's see if I can get something written down neatly. $1 shares, of course, 15,000 shares acquired, but be a little bit careful with that. So I think what I'll do is set up a little group structure, as we have begun to do. Use a ruler, make it look professional. These are the important things. All right, the CSFB date, Consolidated Statement of Financial Position date, is the 30th of June 2015. And so you have Pallister, who has some shares in Stretcher. It's a 75% sub, so of course the NCI will be 25%. And of course, it's a mid-year acquisition. That's extremely important, the fact that it's a mid-year acquisition. All right, what else can I say? The consolidation adjustments, starting with the first one, the first paragraph. So there's no need to do the external calculation, as I'll show you later on. So I need to consider the first paragraph. The consideration for S that's not yet recorded. Not yet recorded. So we're talking about a share exchange just now, so let's make a start. The share exchange, this is where the big marks come from. And everything I do today, in terms of adjustments and little complications, they could be MCQs, of course, and have been in the past. So we were saying a few minutes ago, you bought 75% of my $20,001 shares, the par value, and so you acquired 15,000 shares. Acquired. And so you grab hold of the 15,000, and it says for every 5 you're giving me 2 of your shares. So basically it's 6,000 shares in P, and this is to be multiplied by a crucial $4. And that's the value of the shares in P. So you mustn't pick up $3. The $3 is there just for the NCI. And so if you multiply that out, naturally you come to 24,000. Again, this is in dollars, thousands. And that's going to be broken up into share capital and share premium. Share capital and share premium. So that's my next task. I'm going to break this down into the ordinary share capital, which obviously is 6,000 shares at $1, and whatever's left goes to the share premium, which must be 18,000. So how am I doing this? This is at the rate of $1, and this is at the rate of whatever's left, $3. And these are 6,000 shares in thousands. All right, really easy. Now, the other thing that I must warn you about is you must remember to bring this into the CSFP, the final consolidated statement of financial position. It's very sad when people do all this hard work and then they forget to bring it through. Because remember, the question says, these haven't yet been recorded. So if I show you the question, basically it says that the financial asset equity investments, this 11,500, that doesn't have in it as yet the shares that you issued to acquire my company. And therefore these figures here, other components of equity is another way of saying share premium. So all those figures in the asset side, higher up the page, and the liability side, share capital reserves, lower down the page, none of those have got that transaction in there as yet. And therefore we must bring it in. All right, so again and again, I want you to feel comfortable. I want you to have a look at this top paragraph and feel comfortable about it. Because that's the easy bit, the shares. So can I ask you to quickly run through those shares, please, again? Very high chance of coming up. that has. So it says there, the value of P shares, parent shares, is 4, and the value of S's shares is 3. The moment you put the 3 into the NCI, you can forget about it. The 3 is to help with the NCI. So that's out of the way. So what's the value of the shares you are giving me? You are P, parent, and I'm S. Okay, so you bought 75% of my company. It says there, you're giving 2 shares in your company for every 5 shares in Stretcher. So if I were to show you, for example, with a piece of paper, what actually happens in real life, obviously it's all done through lawyers and whatever these days, and all this, it's all regulated properly. But basically I've got 5 pieces of paper here, you see? As you can see here, 1, 2, 3, 4, 5. There are 5 pieces of paper here. I just put them together. And you are taking from me these 5 pieces of paper called subsidiary, S's shares. Okay. Now what some students do is they think that the shares that are given by the parent are the same shares coming back, which is nonsense. Excuse the language. If you take for every 5 of my shares that you acquire, if you take my shares, it's nonsense to give you my shares back. So you've taken my shares and you've got them. Okay, so you've got them. So what do you give me in return? It can't be my shares. It must be your shares. So you're giving me 2 shares. Okay, so you've taken my 5 shares, and for whatever reason, the deal says you're giving me just 2 of your shares, plus a bit of cash. And so, taking everything together, I'm happy about it. Okay, so if you take my shares, you must give me your shares in return. See, it's slightly different color here. Okay, it cannot be my shares coming back. It is complete and utter nonsense. So that's what the weaker student does, very confused about everything. Not us. All right, so that's the first paragraph, the first half of the first paragraph conquered. The second half is this business about present value. So that's come up so many times as MCQs that I'm going to take it very slowly. So that's the first part, okay? The share exchange. I'm now going for the deferred consideration, leaving a line. This is the one that's done really badly by the person who isn't prepared for the exam. So my job is to get you prepared. Deferred, postponed consideration. Deferred consideration given by parent, of course. Okay. So you've acquired 15,000 of my shares. You're the parent, I'm the subsidiary. And for each of these, you're giving $1.32. For whatever reason, that's what we've decided. And so if you tap into your calculator, that's 19,800. And because you got there 10%, let me just show you. 10% per annum for 1 year, and as you know, for that, the present value factor is 0.9091. That's your PV factor. Okay, the present value factor, 9091. So let's multiply by 0.9091, and so the present value is 18,000. And once you do your present value, you have to do what's known as unwinding the discount. It's like adding back interest. And so what you do is you take the difference between these two, which obviously is 1,800. That works quite nicely if it's 1 year away. But if it's 2 years away, please be careful. Strictly what I should do is I should pick up my 18,000 and multiply by 10%. Because 10% is the discount factor that gave 0.9091. Okay, so if the examiner says it's more than 1 year, or say 2 years away, 3 years away, they will give you the present value factor. It's not a maths exam. Now, the only thing that is troubling me here is the date of acquisition was 6 months into the new year. So in the current year, halfway through the year, the date of acquisition occurs. So come the end of the year, only 6 months have passed. So in your consolidated reserves, what you need to do is to multiply this by 6/12. But for 6/12 only, post-acquisition unwinding. Unwinding means adding interest. And that's obviously to be multiplied by 1800 to give 900, and that goes to consolidated reserves. And don't forget, whatever goes to consolidated reserves also goes to the consolidated P&L, so that the books balance. All right, so do remember that little trick, the 6-month rule, because you have to think about it. If the acquisition was, say, let's say this is my year as a student, if the acquisition was in the middle of the year for this company, in 6 months' time, the interest clocks up for just 6 months. Though I appreciate, after that another 6 months clocks up, and then eventually the 18,000 becomes 19,800. In other words, present value 18,000, by the end of the year it's 18,900, and that 18,900 becomes 19,800 with another 900 for the second 6 months. That makes up the year. Okay, to payment. So all kinds of little tricks you have to remember. What else can I say is important with regard to this question? Let's see. We've survived the first paragraph, more or less. So let's see if I can give it a bit of a tick to signify we've conquered that bit. So my question paper looks quite messy because it's not being marked, of course. But the more I can scribble onto my question paper, the more I can sort my brain out like any good student would do. And then my answer guide is all nice, my answer submitted is all nice and neat and organized. It doesn't matter what your question paper looks like. Okay, but you must scribble all over it. All the good students do that. All right, the non-current assets, property, plant, equipment, financial asset, equity, investments, all kinds of little notes, that's fine. Now, one other thing to ask you about, the retained earnings, as you can see, at the start of the year is said to be 14,000. Okay, so that's at the very start of the year. Look at this. But that is 6 months before acquisition. So what I need to do is to add to it some part of that 10,000. Okay, so I need to multiply the 10,000 by something and then add that on to the 14,000, and that will move me on from the start of this financial year till the date of acquisition. So the emphasis now is on the pre-acquisition retained earnings, because that's crucial for my goodwill and such like. All right, let's go have a little think about this. Together this comes to 24,000, of course, just as that thing on the left comes to 50.2 or whatever. Let's see. Now comes quite an interesting paragraph. The following information is relevant. Stretcher's business, this is the subsidiaries. Business is seasonal. Big, big word. Crucial word. Yes, maybe, if they are an ice cream company, for example, during the summer months of the country in which a stretcher operates, one imagines they'll sell more ice creams. If they are based in a cold country, in the winter months, one imagines if they're involved in selling woolen garments to keep people warm, in the winter months, maybe their sales will be higher. That's what seasonal means. Okay. Stretcher's business is seasonal, and 60% of its annual profit is made in the period 1st January to the 30th of June each year. Okay, that's the kind of thing we're talking about. There was one question where during the Christmas period, the particular company we were dealing with in an MCQ test, it had, I think it was jewelry or something like that, or toys, I think I remember, something like that. The Christmas time, people give gifts and so on. So one imagines that sales will be higher in jewelry and toys, etc. And that was a past exam question. So seasonal is a little trick the examiner uses on you. Just common sense, actually. Now, have a think about this. Stretcher, my business is seasonal, as you can see there, and 60% of my profits is made in the period 1st of January to the 30th of June. So when did the acquisition happen? Going back to the first part of that question, middle of the year, 1st of January 2015 is when that happened. So if you count from there, it looks like the examiner here is referring to the post-acquisition 6 months. Post-acquisition half of the year. So if 60% is in the post-acquisition, one imagines 40% is in the pre-acquisition. Okay, so if I multiply this by 40%, the answer, of course, is 4,000. What I must then do is to grab hold of this 14,000, add to the 4,000, and so at acquisition, the figure will have to be 18,000. You see, that old trick. So what the examiner was complaining about was people didn't seem to have read, weaker students, careless students, didn't read that 60% point and just split the 10,000, 5 and 5, 6 months, 6 months. But that's wrong. In fact, you lose lots and lots of marks for making that mistake. You may not fail on it, but you certainly lose a few marks, quite a few marks, because of course it'll affect your NCI, it'll affect your reserves, it'll affect your goodwill, it'll affect lots and lots of things. So it's a small mistake, but it looks worse than it is. And above all else, it shows as a professional, if I was a student, I'm careless. And that's the last thing a professional wants to give, that impression of being careless. Okay? So you've got to read these things very carefully. So let's see if I can do that by way of a little working. Seems like a good technique. Every time I come across a little problem, almost like a little MCQ, I concentrate on that and pick up my couple of marks. Might actually move on to another page, which for me is about page 5. As per question, point little 1, retained earnings of S, who is the sub, at date of acquisition. In class, please allow me to write a few extra words, because this is being recorded and people will listen to it over the next few weeks. So I'm going to do this very, very slowly and write a few extra words so that you can follow it. So let's say at start of the current year, the figure, of course, is 14,000 plus the pre-acquisition part of the current year, which is 40% of 10,000, 4,000. So we're adding like that, and so this figure that turns up here, of course, is 18,000. So this is at acquisition. At acquisition date. All right, so that's a very, very, very simple exercise. Let's march on to conquer the next bit. At the date of acquisition, which is 6 months before the year end, mid-year acquisition, the fair value of Stretcher's net assets is equal to the carrying amounts, except an item of plant had a fair value of 3 million below its carrying amount, and the remaining life was 2 years. So what I need to do is divide that by 2 years, like we always do in our main course. But of course we've got 6/12ths. And so you have depreciation in a negative sort of style. Post-acquisition depreciation. Normally if the value goes up, you charge depreciation. If the value goes down, the depreciation in a sense is a negative kind of depreciation. The examiners used that trick on us several times in the past. Well, 2 or 3 times, let's say. So it's not the first time. Most of the time the value goes up, but very, very occasionally it goes down and catches people out. So you just follow the common sense logic, I suppose, as I'm about to show you. Very, very easy if you use first principles. Fair value adjustment to S's, subsidiaries figures. First things first, the plant. The plant is a minus 2,000 because it's below the carrying value. CV means carrying value, and that of course affects the goodwill. And then you've got the post acquisition depreciation, which is obviously where you pick up your 2,000 and you divide by 2 years, and so you have 1,000 still in brackets per annum, but of course only for 6/12ths of the year. So the answer there is 500 credit. Okay, so that's just normal split. It's not done in any seasonal fashion because it's not profits as such. All right, so that's that. The big thing is using brackets, I suppose. It's a negative kind of depreciation. Let's read on, see if we can get a few more of these ticked off. The fair value of Stretcher's investment was 7 million. See also note 5. Let's go and have a look at note 5. At the 30th of June 2015, which is the year end, CSFB date, balance sheet date, the fair value of the finance asset equity investments of Pallister and Stretcher were, this is for Pallister and this is for Stretcher. So I suppose I better go back and have a little look. It seems to say for Stretcher it was 7 at date of acquisition. But if you go back to the main balance sheet, you'll see there the figure was 6. So 6 became 7, and 7 of course became something even more post-acquisition. So I need to scribble this down to feel I'm conquering the question. So where shall I go with this? We've just done our funny looking negative depreciation. That's okay, we can handle that. And so here we have our investment by S plus 1,000 7,000 fair value, 6,000 at the top of the SFP. For S in the question paper. So that is at acquisition, you see. This is at acquisition, and because it's at acquisition, it affects goodwill. All those principles. I'm writing quite a lot on the screen, much more than I would in the exam, but I'm hoping to brush up on all these principles and get you a little bit better prepared for that exam. All right, now that is with regard to S, and then from 5 of the question, it's gone up by another 900 fair value adjustment post-acquisition. And because it's post-acquisition, it cannot affect the goodwill. Cannot affect the goodwill. And I might as well handle P. That's to do with S. And as far as P is concerned, there's a 1,700, because if you look at your question paper, let me show you, the figure is 11,500 sitting here. And then if I go quickly to point number 5 on the next page, that figure now becomes 13.2. So it seems to have gone up by 1.7. And that becomes a little additional working there. So I'm going to say 13,200 at the year end minus 11,500, which is, of course, the book or carrying value. And that goes to consolidated reserves in workings. All right, so all pretty straightforward. Interesting that he asks you to join up the last bit of point 2 with point number 5. So you've got to be a little bit careful with that, jumping around the question. But the examiner can do anything, really. We've just got to be there with him. Now, in fact, it's the second last bit of point 2. The last bit of point 2 now coming up. Stretcher, who is the sub, owns the rights to a popular mobile phone game. At the date of acquisition, a specialist value estimated that the rights were worth 12 million. Sorry, 1.2, 12 million, and had an estimated life of 5 years. So that's not in the balance sheet at the moment. So those kinds of things are perfectly okay. And had an estimated life of 5 years. So all I do is divide it by 5, 2,406 months. That kind of thing, standard technique. So let's finish off. So what was that again? At acquisition, some mobile phone game rights so it must be an asset to the subsidiary. The parent values it at 12,000 in thousands, fair value adjustment, that's quite high, but it's to be divided over 5 years, how long it's going to last, those rights. So we've got here 2,400, and of course you've got 6 months of that. And so the figure here is 1,200 post-acquisition, what's known as amortization. Amortization. Okay, so be careful of that. Post-acquisition amortization. So back we go to our question paper and we'll keep knocking these things out, that's okay. Following an impairment review, the consolidated goodwill is to be written down by 3 million. Okay, put a cross besides that, come back to it. And then quite a hefty looking paragraph, these intercompany items and PUP. You expect that somewhere in the exam. It's never not been there. But this one is quite searching, caught out a few weaker students. Pallister sells goods, so I think parent sells. If parent sells, NCI not affected. At a cost, to Stretcher at cost plus 30% markup, okay? Subsidiary had 1.8 million of these goods in its inventory, unsold, or also known as unrealized, at the end of the year, which had been supplied by Pallister Good. In addition, on the 28th, on top of that, just before the year end, 2 days before the year end, Pallister processed the sale of 800,000 of goods to Stretcher, which Stretcher did not account for until their receipt after the year end. The in-transit reconciliation should be achieved by assuming the transaction had been recorded in the books of the subsidiary, I see, before the year end. So they've been sent by you, the parent, to me, but they arrived on my premises 2 days after the year end. Yes, got lost in the post or whatever. And so you sent it 2 days before the year end. It arrived on my premises 4 days later, which is after the year end. And what the examiner is saying is treat it as if they arrived by the year end, but obviously I call it in transit. Okay, so those items in transit are not yet in my stock because the subsidiary hasn't brought that in yet. So the current figure for inventory in my current assets as a subsidiary doesn't have those items in it. But as you solve it, the examiner is saying treat it as if it all ends up there. So it's only a small point, but you must understand what's going on first. At the end of the year, Pallister had trade receivables, a balance of 2.4 million due from a subsidiary. Parent is owed money by the subsidiary. Subsidiary has a liability, a payable. Obviously the receivable, the asset is the parent's, which deferred the equivalent balance due to the sale made on that date. And if you turn the page to page 5, that's on something completely different. In fact, let's read point 6. Pallister's policy is to value the non-controlling interest at fair value at the date of acquisition. For this purpose, share price, yes, we've assumed that. Absolutely standard language. So I need to go back and have a little think about point number 4. You read it again, please, and then I'll present it to you as a little explanation. Like this. So maybe I'll just give myself a little bit of room. Pallister Company, workings, continued, thousands, as per question. Point 4. Intercompany provision for unrealized profit. P, parent sold, therefore NCI must be unaffected. As far as the figure work is concerned, there's 1,800 in inventory. Part of, so this is by the year end, see? Part of the 15,400, have a look, already in the SFP, in the question. Let's go have a look. Where's the parent's SFP? Yeah, and the subsidiaries next to each other. So this 15,400 includes something that the parent sent to me, if I'm the subsidiary or the parent. So says the question. So it's already in there, the examiner is saying. That's good. But let's read on. There's something awkward coming up, what's known as goods in transit, or GIT. So at the year end, P and S, we have to do what's known as a reconciliation. You see, little reconciliation. So we need to debit to cancel S is payables. So these are the debits, these are the credits. 1,600. I also need to debit the goods in transit in S in the CSFP, and that is 800. Apparently that was sent. Must do it in S's books according to the question. And then sensibly, I'm going to credit P's receivables with 2,400. And the big deal when you're doing these sort of questions, or these sort of points, is these two should be the same. That was my own technique as a student. If I felt that the payables and the receivables didn't agree because of something, the difference between the two was that something, obviously. And if the question says that the figure, Pallister had a trade receivable balance of 2.4 million. Have a look at the bottom of page 6, 2.4 million, at least I know what Pallister's figures are. And in a roundabout way, he's saying the 2,400 doesn't agree with whatever figure the subsidiary had as a payable because of the 800. So if I take 2,400 and minus 800 from it, you have 1,600. And so you have a nice composite journal entry. Okay, and then the last step is obviously the PUP. Finally, the PUP. So how about the PUP? Provision for unrealized profit. Obviously, there's 1,800 already in inventory in the books of the subsidiary, plus the special 800, which is in transit, you see. And it's assuming in the books of S before the year end. As per question, in books, it must be in the books of S before the year end, says the question. So that's what I've done. So if you were to add those up, you've got 2,600, and we take 30 over 130. Clearly, that is your markup. 600 becomes the PUP. Okay. Really, really, really straightforward. But you will be getting an intercompany type thing. You might have goods in transit. Definitely get a PUP in every sitting, including the one you're facing. All right, so that's how we progress steadily through all this. And so it seems like a good moment for us to put together the net assets list. This is where, if you can get this right, you're up there with the very best students. So let me set it up as, say, page 7 or so, wherever your handwriting leads you. So we've got here Pallister. Therefore, net assets at fair value of subsidiary called Stretcher in thousands. So make it look all smart and so on. At the top of every page, either the question number or the question name. It's always seen as best policy. So we got about halfway from left to right. I'm going to say at acquisition. I always leave an inch or two here. And then we say at CSFP date. And so the share capital from the question is 20,000 and 20,000. Remember, these are the shares of the subsidiary. I understand from my friends who are markers that some students bring in the shares that the parent issued to acquire the subsidiary. They bring those shares into this calculation. That's so sad. Completely misunderstanding the scenario, which is why the MCQ scenarios are taking such a prominence in the new syllabus. Okay, retained earnings. You remember we did working 1 and stood at 18,000. By the end of the year, of course, it's 24,000. Let me show you where from. If I go back here, 18,000 is at acquisition, of course, and 24,000 is at the year end. So it's not quite a 50-50 split. It's more weighted in favor of the second half of the year. So if I were to do a little ruler like this, you see, if I were to say this is my 12 months, most of the time I can just break it in half, but I can't do that anymore. I can't say 6 months, 6 months. It's biased in favor of one of those half years. In the second half of the year, it's actually 6,000, and therefore the first half of the year is only 4,000. So you mustn't be too mechanical, you must read the question as well. It's a very simple point, actually. All right, let's march on, because I know that if I get my net assets list correct, or my students get the net assets list correct, you're up there with the best in the world. And occasionally some of my students get the world prize. Not often, but yeah, I've had about, I know, 7 or 8 over the years. So world's best paper. They work extremely hard, those students. Not just what I do, of course not. It's 99% down to them. Okay, 2,000, you remember? 2,000 there. And then you've got your depreciation post-acquisition, which is nil. And here, of course, 500. No brackets. Okay, so here we have no brackets. And here, notice the brackets. So depreciation would be the opposite, obviously no brackets. It's obviously in the class notes explained in the first chapter. What else? We have our investment at acquisition that's gone up for the subsidiary by 1,000, 1,000. And then post-acquisition, by definition, must be nil. And this is plus 900. Then you have your mobile phone game, gone up by 12,000 in thousands at acquisition. So the parent has valued that in my books. Sometimes even if I've got things like research, and in my books I've written them off, through the eyes of the group, that research may be worth something, provided the parents, directors can value it. Okay, so can I say that again? The mobile phone game is easy to understand, but let's say there's 12 million of research. As you know, research, IAS 36, IAS 38, I must write it off to my P&L. But even though I write it off on an individual company basis to the P&L, from the parent's point of view, if they feel it's worth something, then it can be valued in the context of group accounts. That was an MCQ in the specimen exam and obviously in the real exam before that. Be careful of that. Just put that in the back of your mind. I'll pick that up later, maybe next week. Then you have your amortization, which is obviously post-acquisition. And that is a plus, well, that's nil there, and this is 1,200. So plus 12,000 minus 1,200. And no pup since the parent sold. No pup here since parent sold. Be careful. If the subsidiary sells, well, that's different. That'll be here. So let's tidy up now. Adding downwards, I believe the first one is 38 minus plus, etc. Something like 49,000. And as you know, that's used for goodwill. Used in the goodwill calculation. It isn't actually goodwill. And if this is 55.2, by adding up those various figures, the difference between this figure and this figure, the difference or the change of 6,200 is obviously used in the NCI and of course consolidated reserves. Okay, and so we commence the various bits with regard to our big three. Done our group structure, done a few adjustments, summarized the adjustments with the net assets list, and therefore now coming to the big three. No associate in this question, but will be in the next one. So we cover all styles. So let's go for goodwill, NCI, consolidated reserves. And so we'll start with the goodwill. GW, goodwill. The investment at cost, which came through a major working, if you remember. You start with the CI, controlling interest, and within the CI, you remember there was a share exchange, and that's always the present value. Share exchange, of course, is 24,000. That's at the moment. Thinking about the deferred consideration being present value, of course. Deferred consideration, present value. Not 19.8, but 18,000. Because the share exchange is now, and the deferred consideration must be now. In other words, present at the present time. So that's that. And then, of course, we mustn't forget the NCI. So I'll bring that through. The NCI at fair value at acquisition is 25% of 20,000 shares in S multiplied by $3, the first paragraph of the question. Remember that? Go check. So that figure is 15,000. So if you were to add that up, I find myself on 57,000. So between the CI and the NCI, it comes to 57,000. The famous $3 is to be found in the, if I just show it to you, in the first paragraph somewhere they should say the value of the NCI. Third line, you can see that $3 is used for NCI. Be careful. All right, so that's the CI and the NCI's view of the subsidiary. What you and I need to do is to set against that the net assets at fair value at acquisition, which from higher up the page, end of the previous page, wherever it is for you, is the one on the left-hand side, 49,000. So I'm going to take this away, 49,000. And so as you deduct it downwards, you find yourself with 8,000, and that is your goodwill at acquisition. And we take away from that the impairment, 0.3 of the question, and that is 3,000. Have a look at 0.3. And so as you add or deduct downwards, you find yourself with 5,000, and that is the goodwill at net book value at CSFB date. Okay, so at CSFB date, 5,000. So check out 0.3 of the question. You see the comment there about the amount of impairment of 3 million. So that's that. My next two concerns, obviously, are things like the NCI and the consolidated reserves. Gives yourself plenty of room, plenty of time to think as well. So your CI has got two parts to it. The share exchange, that's the value of P shares. Deferred consideration is how much money P gave or will give in the future. But because it's deferred, it's postponed. And so if you look at it from here, it's like looking at it with, with the binoculars turned over or something like that. It seems so small in the distance. Yes, because of any risks involved with the future payment, it tends to be discounted, like you do in many other subjects. If anyone promises you money in a year's time, you view it in a different way to the money being available now. So you always have to discount it. But once you discount it, it has to be unwound. So you discount and then you unwind. You discount and you unwind like that. And when you unwind it, excuse me, the figure goes up. That's the trick. All right, excuse me, let's move on to another page as we set up our final page, whatever it is for you. For me, with all the explanations, it's gone on to page 8. Could be something briefer for you. Okay. Thousands. NCI. Done my goodwill. I'm doing the next two of the big three. So from the goodwill, about the third line of the goodwill, at acquisition, the figure was 15,000. Remember that? So if I take you back, just below the net assets list, you'll notice there the NCI, 15,000. That 15,000 I'm thinking about. Okay. That 15,000 from goodwill. That's fine. Then you've got to add to it the growth over the next 6 months, NCI percentage multiplied by post-acquisition retained earnings, and that equals your net assets change. The net assets change, which was 6,200, if you remember. Have a look at the net assets list. The percentage, of course, is 25%, and this figure is 1550. Less the impairment, 25% multiplied by 3,000. So the impairment you took off the goodwill account is shared with the NCI and the consolidated reserves, of course, like we've done throughout the main course. And that goes to your CSFP. Okay, so 15,000 plus the growth since acquisition minus the impairment since acquisition. 3 items, so simple. Leave a line. Let's pick up the consolidated reserves, the one that causes the biggest problems for students, weaker students, of course. Consolidated reserves, also known as retained earnings, but not share premium, other components of equity as they call it. So let's compile this famous list. Always need at least half a page for this, maybe more. P's own now 26,200, 24,000, or we could just call it 50.2, as I was saying earlier. Now come the little adjustments, less the unwinding for 6 months, which was 900, you remember, workings. Then you've got your fair value adjustment. Have a look at working 2, please. So I'm going to add to that P's, parents, investments, fair value adjustment, working 2, and that was, you remember, 1,700 from 11.5 to 13.2, I believe. Less because the parent sold, PUP because P sold, and that can be found in working 4. And if you remember, that figure was 600. So in a strange sort of way, the parent is the most demanding. Usually it's the subsidiary. Never mind. If you have to bring in 3 or 4 items there, that's great. Plus group share of subsidiaries, group share of subsidiaries, post-acquisition reserves, which equals, of course, the net assets change. A bit like we brought in for our NCI 5 minutes ago. So 75% multiplied by the net assets change, 6,200. Excuse me. And so that figure there is 46.50. And then we're going to take away from that the group share of the famous 3,000 impairment. Which is obviously 2250. So tap into my calculator. I find that that big figure there is 52,800. Okay, so nothing difficult with that question. There's a little bit of a mobile phone game or something. That's fine. Just an intangible asset, some rights to get money that the parent is taking over from the subsidiary. So the parent will benefit, so sees it as an asset. There's a little bit of the intercompany money being cancelled, little item in transit with a little pup. The property, whatever it was, went down instead of up. It's fine. Depreciation negative. Investments went up. Absolutely standard stuff from our examiner. Now what you and I must do, not forgetting that we've got to keep a few minutes to do some writing as well, is going back to the question and putting together a balance sheet that hopefully will balance. So let's make a start with that. See how far we can go. At some stage we'll have a few minutes break, come back and do either finish this or do another question. And then when I see in the second session, we'll be finishing off that big question, doing something on published with standards. Okay, and at some stage we'll start on the MCQs. See how the time goes. But everything we do has got to have some meaning, and you have to benefit from it. I can do many, many more questions, just rush through them, and they wouldn't benefit you at all. So from years of teaching, I've been teaching this subject for 25 years, more than that actually. And some of our lecturers were not born when I started lecturing. So, someone was joking with me the other day, chatting, a young lecturer. And in fact, I've been doing this paper for 25 years. Obviously, I'm doing the previous paper for a few years before that. So if you add it all up, at least one thing I can offer you is a little bit of experience of dealing with these various ACCA examiners. I can't say I know everything of what's coming up or anything like that, but it's not far off. But my techniques are tried and tested. That much I can say. That much I can claim. That with your brains and hard work, plus a few techniques from me, 50% should be way, way, way below there. Well, you're well above all that. Non-current assets, PPE, property, plant, equipment. Where's my question paper? Oh yes, I can see there. 55,000. Lovely. Subsidiary, you control all of it, even though you only own 75. You don't bring 75% of it, you bring all of it in. Remember that old rule? And then the fair value adjustment in this particular question seems to be a minus. And the depreciation seems to be a plus. Feels very odd, that. But what to do? That's the story here. 82,100. So in my chapter 1, just after I was explaining how fair value adjustments work, you'll see me explaining the fact that fair value could go down sometimes and the effect on depreciation being negative. I've explained all that in the class notes chapter 1. So if you read the class notes, you'll pass this exam. Good to practice a few of these exam standard questions though. Goodwill. A few minutes ago I remember we had 5,000. You see. Then you've got your gaming rights. Game rights. And that was 12,000 in thousands. Minus 1,200 in amortization terms, and this is 10,800. Then you've got your financial asset equity investments. Which is 11.5 plus 1,750 fair value adjustments plus 6,000 for the subsidiary plus 1,000 fair value adjustment, then another 900, I believe, for the second half of the year. Or what you could do is simply from 0.5 bring in 13.2 plus 7.9, because either way, whether you do it like that, whether you do it like that, the figure is 21,100. So some attempt at adding up is also a good idea. Don't leave the marker to add it up. They'll resent the extra work you're giving them to do, especially nowadays where the marking has to happen very fast. Don't forget the 60% MCQs are marked by computer, and it's the 220 markers that are marked by human beings. And then you have your current assets. You'll start with your inventory, 17,000 plus 15,400 plus 800 goods in transit minus 600 PUP, you remember, 32,600. Good. We'll then bring into play our trade receivables. 14.3 parent, subsidiary 10.5, minus working 4, have a look, 2,400, working 4, 22.4. You then have your bank balance, which is 2.2 plus 1.6, call it 3.8 or 58.8. 58.8 plus 119, 177.8. Also known as total assets. Okay, so I'm doing it very slowly, explaining all the little steps. You just need to do half of that right to pass. But you have to prepare. So please turn over PTO, something like that. And the marker, excuse me, can flick over and have a look at the second half. The second half of the balance sheet is always a little bit more dangerous, I would say. So be careful. We call it equity and liabilities. Equity and liability. So we have the ordinary share capital. Don't forget, it's the parents only, ever. But having said that, you mustn't forget the additional 6,000 shares that were issued. You see, so in the original question paper, there's 20,000 plus the newly issued to acquire S. And that was 6,000 new shares. The working just below the group structure. So this figure here is 26,000. 26. So don't forget the newly, because the question says the newly issued shares have not yet been recorded. And then you have something called other components of equity. also known as share premium, SP share premium. Again, it's P's only, parents only. But having said that, you have the original in the question of 4,000. But of course, for S, acquisition of S, you issued another 18,000. So this is linked to this. Okay, very straightforward. So 18 plus 4 is clearly my 22,000, which is a figure that should turn up there. So shares, 26,000, the other components, 22,000. Then you have your consolidated reserves, or retained earnings. And the figure there is 52.8. Then you have the NCI, which also came through a working. And that figure was 15,800. We then have our current liabilities. Deferred consideration. The present value at acquisition 6 months ago, a little bit to the left, is 18,000 PV. I don't want it 6 months ago, I want it now, which is 6 months later. And this is where we bring in what's known as unwinding, adding back the interest for 6 months, reversing the unwinding to CSFP date. So towards the end of chapter 1 in my class notes, you'll see me explaining the unwinding concept several times, including bits of homework. And so this one is 18,900. Deferred consideration. I'm calling that a current liability because at the year end there's only 6 months left. And so that 6 months falls within the 12-month rule to make something current liabilities. And then of course you've got this other current liabilities, other bits and pieces, which of course is involved with the cancellations. So 25,8 plus 18,1 minus 1,600 working 4. And so this is 42,300. So this is 177.8, and so that's your total equity and liabilities. Total equity and liabilities. Okay, so very, does it add up to the top half of the balance sheet? Let's go have a look. 177. What was that? 177.8. There you are. Always going to add up in class because we take a few extra minutes to do these things. In the exam, it's very hard to get them all done, but 50% can easily be done within the space of time you've got. That much I can say. Now let's have a little read of our question, which is some written stuff. For many years, as you can see there, Dilemma has owned 35% of the voting shares and held a seat on the board of Mino, which has given Dilemma significant influence over Mino. Okay, so these are unrelated companies to the first half of the question. So you've got now two more company names being introduced. Someone called Dilemma, who I'll call D, and Mino, called M. Okay. So they had 35%, and because of significant influence, I suppose they would be treated as an associate. The other shares, 65% in Mino, were held by many other shareholders who all owned less than 10% of the overall share capital. So in other words, Dilemma, that's you, has the main shareholding, 35%, and the other 65% is fragmented. No one has even 10%. They all have single-digit percentages. So in a sense, you are the king or queen or whatever. You're the boss. On this basis, Dilemma considered Mino to be an associate. Good. We suspect to that. And has used what's known as equity accounting, normal accounting for its investment. The examiner is trying to test us on our associate knowledge. In March 2015, get these dates fixed up, about 3 months before the year end. You see? About 3 months before the year end, Aggresso, a third company, made an offer to buy all of the shares in Mino. The offer was supported by the majority of Mino's directors. I see. Dilemma did not accept the offer and held on to its shares. As often happens in these aggressive type scenarios, real life, there's a lot of haggling and fighting going on, unfortunately. On the 1st of April 2015, so I would say that's still a little while before the June year end, April, May, June. Yeah. Aggresso announced that it had acquired the other 65% of the share capital of Mino and immediately convened a board meeting at which 3 of the previous directors of Mino were replaced, including the one director's seat held by Dilemma. So Dilemma's position has been greatly diminished. Dilemma hasn't got a seat on the board. So I would say it has no significant influence. Therefore, no significant influence. Explain how the investment in Mino should be treated in the P&L and the CSFP at the end of June. So basically, M must be reclassified from associate to a simple financial asset investment. That's the gist of it. So I'm going to write here, Mino must be reclassified from associate to a simple financial asset investment. Okay, that's the big one. So obviously you've got Dilemma, who has some shares in Mino. So how to convert these ideas? We have a simple scenario, how to convert it into 5 bullet points for 5 marks. It is that skill I'm hoping to show you over the next few minutes. So let's go have a look at page 3. Yeah, there it is. So the year is 1/7/2014 to September 15. And Dilemma has 35% throughout. 35% shareholding throughout the year. 65% was broken up into small pieces, but now unfortunately someone has come along called Aggresso, the name gives it away, and has hoovered up, has managed to grab hold of the entire 65%. And so obviously you've got 65 versus 35, and clearly the 65 is going to win. And that basically means you have no more, you have no more significant influence. So how do I get marks for saying that? Let's see. For Mino to be treated as an associate, dilemma must have this thing called significant influence. Over M. Dash, let's say this is presumed if there is 20% or more held. Let's say this is usually presumed, reads a bit better. Leave a line, let's pick up the next point. Let's say even though dilemma still holds 35%, it does not have, underline not have, this thing called significant influence over M, as it has lost its seat on the M board. So I'm trying to do lots and lots of little bullet points, hopefully get it up to 5. A bit like how we do our ratio analysis. Markers tend to give 1 mark per paragraph. So if I can make it out, give the impression that I'm doing 5 points in 5 paragraphs, I always have a chance of getting 5 out of 5. I need 2.5 out of 5 to pass. Why not all 5 where things are easy? So M is under the active control of Aggresso, someone called Aggresso, as evidenced by D, dilemma, losing its seat on the M board, minor board, and as such, Mino is a 65% subsidiary, might underline subsidiary, controlled, another strong word, by Aggresso. All right, now we come to the accounting treatment. We've picked up, I'm sure, 3 out of 3. Let's go to the last 2 marks. Again, leaving a line between each bullet. So let's speak about the pre-1/4/2015 part of the year. Acquisition by A. M treated as an associate. Mino treated as an associate in accordance with IAS 28, i.e. the carrying amount is calculated as an associate at 31st March 2015, and profit after tax multiplied by 35% included in Dilemma's consolidated statement of profit and loss, also known as equity accounted. Okay, so that's what goes to the carrying amount obviously goes to the SFP and the profit after tax goes to the P&L. And then what happens post acquisition? Again, making sure I leave a gap. Marker realizes I'm doing something else. The post 1/4/2015 scenario, Mino is treated as a simple financial asset equity investment in CSFP at carrying amount immediately before reclassification. And in the CS profit and loss at fair value through P&L with any dividends received treated as investment income. All right, so 5 marks, 5 points. Do have a break. When we come back in a few minutes, we'll try out another question. All right, thank you very much. Welcome back. Let's have a look at the next part of our program. Here we are. Quite a massive question, that Pallister, but of course we're doing like a 20 marker plus 5 MCQs, totaling up to 10. So 20 plus 10, 30 marks. So it's quite a big one, that. Too big for this exam. On the other hand, it's the same examiner, the same examination committee putting it together, and it gives you some exposure as far as the possible MCQs are concerned. But I'd like to move on, please, if I may, to the revision kit, page 113, where I propose to start a big question called Penketh. Even if you've seen the question in the past, if you're resitting, this is a new style of Penketh. In other words, it's been redrafted with a new exam in mind. Though I have to say, when it first came out, I believe it was a 25 marker. We've taken little bits out, but it's very hard to take everything out. So it's probably a little bit too much for 20 marks. On the other hand, if you look at it like a 20 marker plus, say, couple of MCQs, then you'll get a better, you'll accept the question a little bit better. Okay, get a better feel. So all the time we're preparing for the exam rather than just doing 20 markers. So even though I've tried to cut it down a bit in the revision kit, it still looks a little bit longer than 20 marks, for which I apologize. On the other hand, never wasted. Any preparation is never wasted, especially if it's focused, which is what I'm trying to do. Right, now, let's make some kind of a realistic start with this, then have an hour's break, and that's when we come back to doing our second live session. Okay, so let's make a start. It's called Penketh. Sorry. Where is my revision kit? There it is. So, as usual, the first paragraph, quite daunting. Though I have to say, the examiner usually leaves a little gap there to make it, a little bit more visually acceptable. But sometimes the people who type for the college, they're not qualified accountants, obviously. They tend to do things in a slightly sort of just to save paper. So please excuse that. Not much I can do to change them. It's just one of those things. But the examiner will space it out a little bit better, and the print face should be a tiny bit bigger. But there we are. That's what we have. Page 113, revision kit. Question number 36, called Penketh. And so, as always, I'm quite concerned about the question, what there is on offer, etc. So do have a little read of the question, and you have the question and its requirements. So do please look at that. Thank you. Page 113. So you've got your version of the question. Just read yours. There seems to be some technology problem here with mine, so I'll get that sorted during the session, the hour's gap. But you must read the question. And certainly we can conquer the first few bits together. So look at the requirements, please. Excuse me. Here we are. Question there called Penketh, the requirements, you can read yourself. It says there, Penketh group, consolidated goodwill as at let's go have a read of the requirements. You can turn to page 114. Calculate consolidated goodwill at the 1st of October 2016. Good. And that's your date of acquisition. And as you can see from the requirements, that's 5 marks. I'm going to keep 1 page aside for that. And then on the 2nd, 3rd, 4th page, keep plenty of space, probably 3 pages, a massive consolidated statement of P&L. I think it is unlikely that you'll get an SFP and a P&L all within 20 marks these days. But in the days when we used to get 30 markers, it was quite easy to see that happening. But these days where you've just got 20 markers, I think you'll either get a P&L or an SFP, I suggest. It'll be very hard for the examiner to accommodate both within 36 minutes, whatever you get for 20 marks. All right, so that's my first battle to fight with your help. The next battle, page 2, 3, 4, is Penketh Group dollars. And you've got here the consolidated statement of profit and loss and the other comprehensive income for year ended 31st March 2017, it seems. So you'll have the group there, remember? Then you have your consolidation adjustments. And then we better read the question to see whether there's an associate or not. There very often is. So that's your page 2, 3, 4. And if I can move you on to about page 5, say about here, I'd like to offer you some workings. And so you have there the group structure and the year end. I nearly said CSFP date, that'd be slightly wrong. This is a P&L, which obviously has just 12 months under its coverage. So I'd like you right here and now to read the entire question, and I'll show you the group structure and so on in a minute. Especially important is your point number 3 on the 2nd page. Okay, so I'll leave you free to read the question for the next few minutes, please. Okay, so you can read from your point 3. I'd like you to read that. In fact, I'll give you a few more seconds to read the entire question, especially point 3, where you acquire 30% of Ventor's equity shares. 1st of October 2016 feels like mid-year. So in the middle of the year, you bought a 30% interest in Ventor. And clearly, if you're using equity accounting, the impression is that it is an associate. All right. So you've got a, a subsidiary called Sphere, 60%. That's quite straightforward. because you bought 90 million out of my 150. You see? So let's see if I can pick up one or two ideas this side of the end of our session. Get a little bit more done. So you bought 90 of 150, so 90 over 150 clearly is 60%. The NCI, 40. Lovely. It also says the acquisition was achieved through a share exchange. Here we go. Of 1 for every 3 acquired. 1 for 3. As we said in the previous question, if you acquire whatever 90 million of my shares, you haven't acquired the other 60 million. That is still with the NCI. So you can't offer your shares to the NCI. You can only offer it to the people whose shares you're buying. That's really important there. Okay, so 1 for 3, as we say. Extremely important to understand, accept that idea. Okay, read on, please. Get familiar with the rest of the question. So as usual, if let's say I'm Sphere with 3 shares, for every 3 shares I have that you acquire, so you acquire 3 of my shares, and how many of your shares do you give me? Just the 1. Okay, and if the examiner gives you the price for the subsidiary shares, the only reason they're giving it to you is for NCI purposes. But the one to concentrate on is the value of the parent shares. Yes, okay, you mustn't get confused. It's really straightforward. But the weaker student who hasn't done any questions can't work out why they're being given the subsidiaries value, and they get all confused and use the wrong valuation. So just shows you haven't done enough questions. The marker can see that within 1 second. Don't let that be your script. What else? Excuse me. The $4 is what I'm concentrating on. The $2.50, of course, is only for NCI purposes. Okay, so I'm going to say for NCI. Additionally, Pencut will pay 1.54 cash on such and such date. I think that's 1 year away, isn't it? 1 year after acquisition, that is the acquisition date, mid-year acquisition. On the grounds that the year we are dealing with is 1/4/16 to 31st March 17. Really, really easy stuff, this. Pencut's finance cost is 10% per annum. Present value factor of 0.9091 must be used. Unwinding the discount is calculated at 6.3. So if they've given it to you, just use it. Don't try to work it out. And it must be charged to the consolidated P&L as finance cost. So they're telling you how to deal with it. The retained earnings brought forward is 120. That's the start of the current year. So this is the parent, and this is the 60% sub. So even though they haven't given you figures for the associate, there is an associate, as you saw on the second page. Okay, so brought forward, this is at the start of the year. Do be careful, because the acquisition, as you can see, is in the middle of the year. And so what you can do, I suppose, is to grab hold of the 80,000 multiplied by 6/12, which is obviously 40,000, that 40,000 plus the 120 at the start of the year equals obviously 160, which is at acquisition. $160 at acquisition. Okay, so that's going to be something we've got to deal with. This is what's known as the OCI, this thing here, other comprehensive income, quite straightforward. The investment income I'll have to analyze. There's a note 3. You can easily sort something out. So let's get going with this, get some of this done, then have an hour's break and then come back to session 2. As with all these questions, there are so many tiny bits in it. Any of those could come up as those 60 marks of MCQs and have come up. So please be careful. All right, what else? What else can I say here? There is some purchase consideration information which I can put directly onto my first page. But having a read of point 3 of the question on the second page, I notice there's an associate here as well. So the group structure becomes a bit clearer once I read that. So let's be systematic. Let's have parent, Penketh, and then coming off in this direction is the subsidiary 6/12, post-ac, and then over here 90 over 150, 60%, sub NCI 40%. And then coming off in this direction, we have V on the second page, point 3. There's a 30% associate. And of course, the associate is deemed to be outside the group. So remember when we did our questions like per sil, we keep the associate to one side. And so if it's 6/12 post-ac, you have to be a little bit careful to read the whole question. And then you suddenly realize the examiner is trying to sneak in a little associate not mentioned in the main P&L. And so we march into the second step. Group structure done. Consolidation adjustments coming up fast. Everything we do must give the impression that we've done something like this in preparation for the exam. The odd 3 or 4 marks we can guess at. Inevitably with MCQs it does happen. But the big question should be well organized. Yes, you've got to give the impression that you've done lots and lots of work. The first paragraph, by the way, the information on purchase consideration is put directly into answer A, if you want to. First paragraph, directly into answer A. In this particular question, the goodwill seems to be one of the main requirements. So let's be adaptable and do that bit as soon as possible, like now. Basically the first paragraph. So let me take you back. Excuse me. This question. Right, consolidated goodwill, date of acquisition, as we did on the previous question, and you will do in the exam probably. Investment at cost, CI. Within the CI, there is the share exchange, which is the acquired 90,000 divided by 3 shares and multiplied by 1 gives 30,000 shares in P. 30,000 shares in P. And those shares in P are valued at $4. Could be extremely careful in the exam not to mess that up. So that's 120. I know there's some reserves of 120 around the place as well. The examiner is very fond of using very similar numbers to see whether you can concentrate. All right, so that's the first battle I've fought. Now let's go for our deferred consideration. Deferred consideration in cash in 1 year's time after acquisition. 1 year after acquisition in cash. And so because you've acquired 90,000 shares, you see, and each of these shares is worth 154. If you multiply it out like that, this appears to be 138.6 in terms of thousands. And this is to be cut down to present value by calling this present value 126,000. And needless to say, if you take 10% of that for 6 months, the figure should be 6,300, but the question has done that for you because it's only a 20 marker. All right, so that's your CI. Now comes the NCI, which means 40% of the subsidiary multiplied by 150,000 shares which obviously equals 60,000 shares acquired by the NCI or held on to by the NCI, multiplied by 250 given, that's to do with S's shares. tapping into my calculator, I find myself with 150. All the time giving the impression of having done this kind of thing before. And even if you haven't quite done all the homework, you can see on these revision days, I'm doing quite advanced stuff. Hopefully you've done some basic tuition work with me, some homework, and then this will make that much more sense. But if you haven't, as long as you can remember these questions with the odd little reference back to the basic class notes, even that would be wonderful. Less, so that's your CI and NCI. Remember when you buy when you buy a subsidiary, you're buying two aspects: the things, the buildings, property, etc., machinery, stock, paying off liabilities. You're buying the things and you're buying the people. The people represents goodwill. Or put another way, the people's reputation, their ability to generate profits, all this happens to be goodwill. Okay, less the things. Net assets at fair value at acquisition. That's from your net assets list. Where else? And that's your working. In due course, we'll come up with a number, 200,000-300,000, whatever, and hopefully it'll be smaller than 396 to give us 73,000. No goodwill impairment mentioned. So goodwill at acquisition is what the examiner calls consolidated goodwill at date of acquisition, which happens to be 1/10/2016. All right, really, really straightforward. Just to practice the present value thing there, in case the examiner doesn't give it to you, if I just do an optional extra explanation here, if the present value is 126, and if you were to multiply it by 10% and take 6/12 of it, because the acquisition was in the middle of the year, if you multiply that out, the figure is 6,300, which is called unwinding of the discount. So you discount it down and it goes back up. And as you can see, if you do another 6,300, the 126 will be back to what you would have wanted to have paid, or will have to pay, parent will have to pay 138.6. Okay, so 126,000 plus 2 lots of 6,300, which is obviously 12,600, is what will make that into 138.6 in due course. Unwinding is really easy. Unwinding comes up regularly. Now we're used to the idea of an associate, so I think what I'll do, excuse me, is to set up my important 3 pages here by saying group consolidation adjustments, working from right to left, 30% associate, 6/12 post-ac. Then near that we have the subsidiary, which is a 60% sub, and of course 6/12 is post-ac. And near that, of course, you have the parent. And if you remember, you ignore the associate until you reach profit after tax stage. Ignore the associate until profit after tax stage of the associate, as we will see. Just in class, I'm reminding you of that. And then in due course, you have your revenue, your cost of sales, all that kind of thing. If you keep 3 pages aside, you can then relax, because you know you'll be able to fit everything in. And before we can make any more progress with this, I need you to read the second page to see if you can grasp some of these adjustments. For example, on the second page, the following information is relevant. A fair value exercise conducted at the date of acquisition. So near the 1st of October, can you write at acquisition? Concluded that the carrying amount of Sphere's net assets were equal to their fair value with the following exceptions. The fair value of Sphere's land was 2 million in excess. So near that, would you write FVA, fair value adjustment? And then you have plant, that's land, of course, land is not depreciated, but plant is different, 6 million in excess, fair value adjustment, remaining life of 2 years, 6/12 of that, of course, all that goes to cost of sales. And then the good trading relationships are worth 5 million, a bit like our story about the mobile phone game. Amortization of 500,000 is to be charged to admin. Okay, and then it says Penkap's group policy is to revalue land. Excuse me, land is not depreciated at the end of each, underline end, and that says, in addition to the fair value increase in Sphere's land of 2 million in note 1, upstairs, higher up the page, it increased by further 1 million since the acquisition. Underline the word since. Okay, so let's handle all those little things. as we start scoring some serious marks. So where am I? Let's see. So lower down my group structure page, we decided to transfer the purchase consideration, NCI, and that kind of thing directly onto where the 5 marks is going to go. So just to make the marking process easier, if you want to. Also, to score good marks, I must show all my little steps. Another technique, if you are doing an MCQ, is to put these little bits directly onto your answer. You know, net assets list or whatever. So it saves a bit of time. But since we're doing a longer question, we can relax and do it in the traditional style. This is at acquisition. And that's up by 2,000, you see. Land, and that's not depreciated. Of course, that affects goodwill. Then you have your fair value adjustment at acquisition to plant. Plus 6,000 goes to plant, divided by 2 years, multiply by 6/12, and that gives you a post-tax depreciation of 1,500 basically. And of course, if something is at acquisition, it does affect goodwill, but if it's post-acquisition, it cannot. Of course, in class, I'm repeating all these little principles, and the exam don't waste time. Just hold it in your head and do it, because the speed is unbelievable. Okay, for that 20-mark question, you probably have about 40 minutes. These days, of course, the 50 minutes, what used to be reading time, you're allowed to use that to do the questions. So to be able to do that question in about 40 minutes is very hard, really. So you have to be very disciplined. Right, now we come to this interesting little idea of customer relationships. So basically, you've looked at my books in detail. You're going to take over my company. I'm the subsidiary or the big parent. And you realize I've got very good relationships with my customers that in the future is going to generate revenue. And so you're giving some value to that, see? Because I've spent a lot of time keeping good relations with my customers. So fair value customer relationships. Intangible asset. I know the college I work for, LSBF Interactive, they have relations with different parts of the world. I was sent to Moscow to lecture a little while ago. Was it 18 months ago, something like that? 2 years, 18 months, I can't remember. And there I had to lecture to one of these big accountancy firms. And very bright students, very impressed, hardworking, very bright. And I did the F7 course, the revision course, in 2 days, because that's all time they had. And if someone was buying LSBF, let's say some massive company, Interactive LSBF, they would say, well, you've got all these relationships with big firms all over the place, Moscow, elsewhere. You haven't got any value for those relationships because they're intangible in your present balance sheet, SFP, but we place a value on that. Yes? Because in the future we will get benefit from the profit you make by keeping up all those relationships. So somehow it has value in the eyes of the buying company. That's the kind of thing we're talking about. Because for the next so many years, Those big firms will be sending their students to LSBF Interactive, or we'll go out there to teach them there. So it's got some value. That's what I'm trying to say. Just a practical example I'm involved with. Intangible asset. 5,000 fair value adjustment at acquisition. Therefore affects goodwill, divided by 5 years. You see? And the post-acquisition amortization has been given as 500. And of course that doesn't affect goodwill, but it must go to admin. So all that's been given to you. Okay, so continue to read that second page, please. See if we can get a little bit more meaning out of it. There's the fair value adjustment to land. Since it's post-acquisition, it can't affect goodwill. And that's another 1,000 apparently. So maybe I'll start another page. So here we are. Somewhere around page 6 for me up here. Any of these little adjustments could come up as MCQs, scenario-based MCQs. You could easily get a group as the scenario, you see in section B. So that's S, to land, since post-acquisition cannot affect goodwill. And it's plus 1,000. Okay, now let's read point 3. On the 1st of October 2016, just write mid-year acquisition somewhere near there. Penketh also acquired 30%, near that can you say therefore associate, of Vento's equity shares. Vento's profit after tax for the year ended was 10 million, and during March 2017, Vento paid a dividend of 6 million. Okay, so if you multiply 6 million by 30%, the figure of course is 1,800, and that went to the parent. Because if I'm Vento for a second, the associate, and I pay a dividend to everyone who's a shareholder on my register of shareholders, the parent, will get 30% of any dividend I pay because you have 30% of my company. So 30% of 6 million is what? You're right, 1.8 million. And that's why we've got to consider that. Uses equity accounting, as we were saying earlier. Sphere did not pay, the subsidiary did not pay any dividends in the year ended, etc. So let's go have a look at that investment income thing. I noticed on the first page there's 5,000 sitting there, but I reckon 30% of, what was that, 6,000, which is 1,800, is from the company called Vento. So I reckon sitting in there is something like 3,200, which comes, from an external company. What's called external. If you've done that question I set for homework a long time ago called Pill and Sill, in the class notes you'll see me dealing with external issues. It comes up elsewhere in the class notes many times. If we do the homework, I'm suggesting at least as much of that as you can manage. It just gives you a chance to reinforce all these ideas. All right, let's see if I can get a couple more bits done before I call an end to the session. So investment income, let's see. The investment income is in parents, that's P's, profit and loss. In the question, there's 5,000. And we're going to say less associate V's dividend paid. P's 30% share multiplied by 6,000, the amount I paid, is 1,800. And therefore the external amount, investment in some HSBC or some international outside company, is 3,200. External, and that's shown in CS profit and loss. Okay, so that's directly in there. Then I notice there's some intercompany sales. Let's have a little read. Once I'm reading from the question, point number 4. After the acquisition, underline after, Penketh sold. Near the word Penketh, can you say parent sold? Parent sold goods to Sphere for 20 million. Good. So I'm doing some intercompany sales in due course. Sphere had 1/5 of these goods still in inventory at the end of the year. In March 2017, Penketh sold goods to Ventor for 15 million, all of which were still in inventory at the year end. So parent is doing the selling, requiring a provision for unrealized profit of 900,000, all done for you. All sales to Sphere had a markup on cost of 25%. Next paragraph, Penketh policies to value the non-controlling interest at date of acquisition. You can just tick that off. All the above items, in all of the above, the profits accrue evenly, unlike the previous question, Pallister. So I can tick off, please tick off 5 and tick off 6. What I haven't ticked off and must tick off in a few minutes is intercompany sales. Okay, my last point before we have a break to this session, come back and finish off this question, of course, and then do some published later on today. Intercompany sales. Right. Where am I? P parent sold to S sub. Therefore, NCI does not suffer or unaffected. And so we've got 20,000 multiplied by 1/5 unsold, multiplied by 25 over 125 equals 800 PUP. And that's going to be deducted, if I can just finish this off now. I'll just give you a quick revision of the basics. Consolidated reserve, or P's reserves, 800, and deducted, of course, from inventory in the CS FP, current assets. Of course, that'll be another 800. And that must not be shown in the net assets list because the parent sold, you see. So therefore, not in net assets list. And then the final little adjustment here is P has sold to V, the associate, and the PUP is given as 900. And there we end our coverage for the morning. But I'll just set you up for the second session. In due course, we're going to have net assets of the subsidiary S at fair value, etc. Okay. The story, therefore, what have we done today? We've looked at that massive palette. I've shown you what's coming up in the exam and how the new exam structure works. I've then taken you into the question called Pallister. Huge question, a bit too big for the exam, but never mind. It's like doing a 20 marker plus 5 MCQ scenarios. And then you've got your Penketh, which we've cracked. We've done all the adjustments and all the difficult bits. But what I need to do is to come back and do the actual P&L in an hour's time, finish it off, and then do a nice big published accounts with tax and financial instruments and revaluations and investment properties and all kinds of tricks. And that's our brief for this afternoon or the next session. And then when I see you next week, I'll pick up some of these MCQs, run with those. And then in the time that we have available after that, I intend to do this, by the way, I should say Friday, my apologies. Friday revision mentoring session, not the Tuesday there. Please change that. Okay, so more about that later when we come back together. We've done 1 out of our 4 sessions. So we're coming back to do the others soon. Thank you.